Welcome back to The Explainer. Today, we're zeroing in on a massive tech mystery surrounding Cerebras Systems. You probably know them by their ticker, CBRS. We're going to dive deep into their completely dramatic post-earnings reaction from August 12th. It was one of those days that left even the most seasoned investors scratching their heads and going, wait, what exactly just happened? Honestly, if you invest in tech at all, this whole story is basically a masterclass in how Wall Street is actually valuing AI right now. We're going to look directly at the numbers and how their business is set up to unpack exactly what the market saw, what it completely missed, and what the whole shebang means for the future of AI hardware. Let's get into it.
Okay, so here's the initial shocker. CBR shares plummeted about 12% right after they dropped their second quarter earnings report. Now, usually a double-digit drop in a single day is a giant flashing red light, right? It normally screams that a company totally missed their targets, or maybe lost a massive client, or just slashed their future outlook. But as we're about to see, the initial data actually painted a totally different picture.
Because look at this. On the surface, this report looks like an absolute blowout. Cerebras actually beat their own internal guidance. Their core revenue hit nearly $210 million, which is a massive 103% year-over-year growth. And it gets better. Their really crucial cloud services revenue, that surged an unbelievable 287%. By pretty much any traditional top-line metric, they knocked it out of the park.
So what gives? Why did this massive revenue beat trigger a 12% stock dump? Well, it all comes down to how Wall Street is playing the game right now. In today's market, especially with these high-flying AI tech stocks, investors are just absolutely laser-focused on near-term profitability and forward guidance, way more than just raw top-line revenue growth. A strong top line just isn't enough anymore if the underlying costs to generate that cash are spinning out of control.
Okay, let's look at the arguments. Section 1, the bull case, focusing on their massive backlog and the pivot to inference.
To get why the bulls are so hyped on Cerebras, we first need to define a really crucial metric, remaining performance obligations, or RPO. You can basically think of RPO as a giant, legally binding IOU from clients. It represents contracted future revenue. It's money that clients have already firmly committed to paying for services or hardware that just hasn't been fully delivered or hit the balance sheet yet. It is pretty much the ultimate indicator of a company's future health.
And that brings us to this literally staggering number. As of their Q2 report, Cerebras is sitting on over $25 billion in RPO. $25 billion. Seriously, let that sink in for a second. That kind of backlog gives them almost unprecedented visibility into their financials for the next few years. For the bulls, this $25 billion cushion is the ultimate proof that the demand for Cerebras tech isn't just real, it's practically bottomless.
Thanks to that mountain of a backlog, management is throwing out some seriously bold, long-term guidance. As that $25 billion converts into actual recognized revenue, Cerebras is expecting their core revenue to more than triple by the year 2027. That kind of massive, accelerated growth runway, that's exactly what growth-focused tech investors are always hunting for.
So how exactly are they landing these monster deals? 2 words, AI inference. If you think about it, inference is the answer phase of an AI query. You know, when you ask a chatbot a question, the speed at which it actually talks back to you, that's inference. It requires incredibly lightning-fast outputs. And Cerebras isn't just building generic chips here, their unique wafer-scale chips are custom-built to absolutely dominate this rapid answer phase. It's that specific targeted technological edge that's scoring them these huge partnerships with hyperscalers like AWS and OpenAI.
And to really lock down this space, they're deploying a super clever disaggregated inference partnership with AMD. Here's how it works. Step 1, AMD's Helios racks handle the initial incoming query. Then, step 2, the system seamlessly hands it off to Cerebras chips to generate that lightning-fast final output. This whole setup is expected to be in production later this year, and it'll hit AWS Bedrock in early 2027. This isn't just a cool tech demo, it's a really vital business move to diversify what they offer and embed themselves super deeply into the broader tech ecosystem.
But of course, there's always another side. Let's look at Section 2, the bear case, focusing on margin compression and customer risk.
So, we have to address why the stock actually took that nosedive despite all the insane growth. Well, the bears are hyper-focused on margin compression and the massive execution risks of scaling up a hardware company. Wall Street absolutely panicked when they watched core gross margins slide from 46.5% in Q1 down to 40.6% in Q2. And honestly, it gets worse. Management warned that Q3 margins are going to drop even further, likely landing somewhere between 38 and 40%. In the hardware game, shrinking margins paired with crazy rapid growth usually means one thing: a company is bleeding cash just to fulfill their orders.
So why the huge cash bleed? You could call it suffering from success. To keep up with all this surging customer demand, Cerebras is temporarily and very, very expensively having to literally rent back its own systems from its cloud customers. Let that concept marinate. They are renting their own tech back. It's a ridiculously costly stopgap measure they're stuck with until their own dedicated data centers are finally built out. Now, management swears this is just temporary and they're eventually targeting margins over 60%, but right now, it just proves how wildly expensive it is to scale physical hardware at this kind of speed.
Then there's the second big red flag for the bears: immense customer concentration. Look at this breakdown. Just 3 clients make up a massive 76% of their entire Q2 revenue. You've got customer A at 34%, customer B at 32%, and customer C at 10%. That leaves a measly 24% spread out across literally everyone else. If just one of those top 3 clients sneezes, Cerebras is going to catch a serious cold. It is a dangerously top-heavy business model.
And even the company acknowledges how fragile this is. They've explicitly stated that OpenAI will remain a meaningful contributor to revenue all the way through 2027. When you are that heavily dependent on a single titan like OpenAI, any little strategic pivot, any contract dispute, or even a minor hiccup from that one client creates massive, totally uncontrollable stock volatility for Cerebras.
Which brings us to Section 3. Wall Street's verdict, taking a look at valuation and consensus.
With this massive tug-of-war between explosive long-term growth and these huge short-term scaling expenses, how is Wall Street actually pricing this? Well, surprisingly, the analyst consensus is still incredibly bullish. Even with the post-earnings drop down to around $219, 11 different analysts currently rate it a strong buy, setting an average target price of $300. The big players are all in too. UBS is targeting $330, Wedbush is at $290. All of this suggests they're seeing over a 30% upside from that recent dip. It really looks like Wall Street is buying into the long-term AI inference narrative and sort of looking past the short-term margin panic.
But, we still have to live in reality and look at their current balance sheet. The valuation is undeniably stretched right now. In Q2 alone, Cerebras posted a $450 million GAAP net loss, and a huge chunk of that was driven by stock-based compensation, which, as we know, ultimately dilutes the existing shareholders. So, yes, revenues are climbing at breakneck speed, but the bottom line is still heavily in the red, and that's keeping their price-to-sales ratio uncomfortably high compared to other semiconductor peers.
Actually, I think one analyst hit the nail right on the head here. They said the market is in a post-IPO discovery phase. That single sentence perfectly explains the wild 12% swings we're seeing. The market is quite simply still trying to figure out what a realistic, long-term valuation looks like for a company that has this incredibly unique, highly sought-after hardware, but is dealing with a super concentrated customer base in a massively expensive scaling phase.
So, bringing today's explainer to a close, we really have to weigh this high-stakes bet side by side. On the left, you have the bull promise, that mind-blowing $25 billion backlog, elite purpose-built inference tech, and these top-tier partnerships. But on the right, you've got the bare reality, an unbelievably expensive path to scale, some pretty scary near-term margin drops, and high customer concentration. If you're out there analyzing this data and thinking about maybe buying the dip, there are a couple of major catalysts you need to be watching closely over the next few months. First, keep your eyes glued to the pace of their data center build-out. The faster they get those built, the faster they can stop renting back their own equipment. Second, watch for the exact timing of that margin recovery. Management is targeting Q4 for a bounce back. If they miss that target, expect some serious turbulence for sure.
Which really just leaves us with one final, absolutely critical question. Is a massive, long-term AI payoff worth the very real short-term pain? That is the billion-dollar puzzle investors are trying to solve right now. Thank you so much for joining me today on The Explainer as we work through the crazy data behind this company. If you like learning through these structured visual deep dives, make sure to stick around for more. Until next time, keep learning.